What percentage of your income do you need when you retire? Well, I don't know. I've had a lot of free time in 2020. And if you type that into Google, the response back is you should have about 80% of your pre-retirement salary. So the example here, if you make $100,000, you should plan on having about $80,000 a year as passive income. Today I want to challenge that number. I think it's wrong and way too high. I think it can be less than half for the self-employed. And today I want to run you through some basic numbers and why I think that's the case. Welcome to The Cranky Cameraman. My name's David. I have worked in freelance video production for over 20 years. Been in self-employed for the vast majority of that. And a lot of the retirement advice you see from financial institutions, investment brokerages, it's really catered towards the employee of a larger organization. There isn't a whole lot of info out there for kind of the self-employed, or specifically those of us that work in this like non-union, one job at a time, a day at a time, freelance work, working in video. Here are the top level assumptions. You're self-employed, single filing, no dependents. You're going to use the peak income years here, so the assumption is you're getting sort of near the end of your career for these projections, getting ready to transition over to part-time or just hanging it up completely. You own your housing versus renting, paying a mortgage or not, and each month or year you're reducing debt. You're not accumulating more credit card debt or other business debt. You've got it to the point where you're reducing balances. And then my final projection here on less than half the income also assumes that your expenses will be the same in your year one of retirement as your peak income years. All right, so I'm going to try to reveal this line by line to make it a little more dramatic and easier to follow the narrative. But let's assume you're like me and you work on video production projects. I don't know, maybe it's web related, maybe it's like a graphic design thing, maybe it's an entirely different occupation, but same idea. You get hired per project, you send an invoice, you get paid. And I know from my peer group here in California, if you've been at it for 10, 15 years, you can, if you're hustling, you can gross about 120 a year. Over under on that's probably a 2x multiple. And but anyway, we'll just use the 120. And I'm going to assume here for these, just for simplicity, that you're either an LLC, a sole proprietor, with a DBA, just like 1099 style. You're not payrolling yourself within your own company. So gross income, 120 grand. And based on that, the effective federal income tax rate and state of California income tax rate are 16.71 and 6.59. I used a tax calculator to come up with these numbers. So you can see here, top level, you're paying 20 grand to the state off your gross, another 8,000 to the state. Now, the joys of being self-employed is you get to pay both sides of the FICA tax, which is 7.65 and 7.65 for a total of 15%. Now that is not a progressive tax rate. That's like dollar for dollar up to the income caps for Social Security and Medicare. So yeah, $132,700 is the income ceiling for Social Security benefits. But Medicare, it keeps going. But the majority of it's for Social Security. So you can see here, we're under the cap. So next, that brings our net pay to $73,680 after the taxes. And then I'm going to add in a savings rate of 12%. So putting away $14,400 a year, and that's 12% of the gross income. And then I also put in the mortgage payment, just principal and interest. So the presumption here is at some point you're going to pay off your housing and you'll just be left with your ongoing expenses with housing, property taxes, insurance, maintenance, utilities. But you'll have that principal and interest at some point in the future. Hopefully it's gone. So that brings us to what I'm going to refer to as net income. So what's left over after paying that mortgage payment, taxes, and saving. $44,880. Okay, so I'm going to use that 44K as a base. We'll just round it up to 45,000. So let's say you get down the 10, 15, 25, 30 years down the road, you're ready to retire. And again, this projection is based on your peak earning years, your best years. Okay, low tech number reveal. Now let's jump ahead and say we're in year one of no longer earning an income. You switched over to drawing from your savings to support your annual expenses. And again, assuming year one, I'm going to need the same net income to cover the same level of expenses. Year one would be the same year as the final year of working full time. So 45,000. And we're going to assume we're still paying down the mortgage, principal and interest. But now that we're drawing from savings, it doesn't really make sense to contribute to savings, so I can remove that 12%. And that increases the net pay, or the net after-tax amount you're pulling from your savings, to 59,544. And if we plug all of those effective tax rates in reverse, the first wonderful item is FICA tax is savings are not subject to FICA tax. So that's an instant 15% savings on every dollar you pull out. And then your effective tax rate for state and federal is reduced because ultimately we only need $72,000 to net the same amount after paying for that mortgage payment. So going back to the general rule of thumb of you only need 80% of your final salary, peak salary in year one of retirement, I've already exceeded that just by removing FICA. Because we're self-employed and you got to pay both sides of the FICA tax, instead of it being a 7.65 reduction in tax, it's a full 15%. So 72,000 is all you need, and 72,000 is a 40% reduction from 120,000. Now, if we continue on, it gets even better. All right, so we're back to 45,000 is our net income that we need. But now I've paid off my mortgage. So that's zero. And again, I don't need to save because I'm withdrawing from savings. Net pay would be the same as what I'm calling net income, since I'm not subtracting savings and mortgage payment. Don't have to pay FICA. And the effective tax rates are again reduced because we need to withdraw even less. Now we're down to 52,000. And 52,000 is a 56% reduction from 120,000. So the number gets even smaller because the withdrawals from after-tax savings accounts are not taxed as earned income. It's actually the long-term capital gains tax rate. So we don't need 52,000. We actually only need 48,000, and that's because the assumption here is there's no additional earned income beyond the 48,000 that I'm withdrawing from hypothetical savings. But so in 2020, the capital gains tax rate is 15% at the federal level, but that only applies when your combined gross income is over 40,000, and it's only for the amount above 40,000. In other words, the first 40K is tax-free. So in this case, 48,000 means only $8,000 is taxed at 15%. So that works out to $1,200. And then in California, double check my projection here, but the way I understand it is California just taxes capital gains the same as earned income, and that works out on 48,000 to a tax rate of 3.01. So it's interesting actually paying more to California than the Fed on that distribution. And again, like, we're not saving because we're withdrawing from savings, and the mortgage is paid off. And our net income still around 45K, and that's a 60% reduction from 120,000. Okay, so the capital gains taxes will effectively be even less than I'm estimating here, because some of the withdrawal will be cost basis. So for example, let's say I sold some stock that I originally bought for $10,000, and when I sold it, it had doubled years later, and I sold it for 20 grand. So I don't pay cap gains tax on the full 20 grand, only the amount that it increased, which would be $10,000. So if I'm pulling out $48,000 in the calendar year, a portion of that's going to be cost basis funds that are not taxed. So this really surprised me playing with these numbers today, that that rule of thumb doesn't apply when you're self-employed. It's not 80% of your income, peak income before you're retired. It's less than half. In this case, that's 60% reduction, and possibly more with a little bit more tax efficiency. And then there's all those like scary unknowns, like, oh yeah, you got to have an emergency reserve. How much is healthcare going to be? I'm banking that some form of the ACA will continue to exist, or a variation of it. Something where I'm not going to be burning 50% of my annual income on healthcare. I don't know, maybe I'm crazy. And then Social Security, at some point that's going to kick in. Take it early, take it on time, take it late. Yeah, maybe it'll be reduced. The benefit percentage will be lessened from where we are at today. What about inflation? I feel pretty good on the inflation thing. I'll cover that in a future video. It's just easier for me to visualize and understand things in like today's numbers, knowing that my savings will continue to grow and outpace inflation over time. So I think the big takeaway from this is, one, it's a relief to know I don't need 80%. And two, it's super important that you're saving as self-employed a minimum of 15% of your gross income. And I've had years where I haven't saved that. And then there's other years where you got a big project and a windfall, and I can put a big bucket away and catch up. And I haven't talked about deferred retirement savings. This is, this projection I ran is just assuming after-tax dollars sitting in a brokerage account, savings account, or some other after-tax asset. It's not an IRA, it's not a 401k, it's not a Roth. And I'll talk about those more in depth in a future video. All right, that's it for today. Thanks for watching.